Something extraordinary just happened in the global metals market, and it could change how we think about money forever. For years, the world has been conditioned to believe that the dollar's dominance is permanent, unchallengeable, almost natural. That no matter how reckless fiscal policy becomes, no matter how large the deficits grow, there is simply no alternative. But behind the scenes, something has been changing, patiently, methodically, and without asking for permission. And over the weekend, a signal was sent that suggests the next phase of this shift is no longer theoretical. It's starting now, and it's bigger than anyone could ever imagine. In a carefully worded commentary published in Schiff, the official journal of the Chinese Communist Party, excerpts of remarks from President Xi Jinping revealed something that should not be taken lightly. Xi is no longer speaking in vague terms about reform or modernization. He is now openly advocating for China to establish what he calls a powerful currency, one that is widely used in international trade, investment, and foreign exchange markets, and crucially, one that attains reserve currency status. This was not rhetoric aimed at domestic morale. This was a strategic declaration. She outlined a roadmap to get there, emphasizing 3 pillars: a powerful and credible central bank, globally competitive financial institutions, and international financial centers capable of attracting global capital and influencing global pricing. In other words, the infrastructure required to challenge the dollar system itself. And the timing matters. These remarks come as the U.S. administration shows little concern for a weakening dollar, effectively tolerating, and some would argue encouraging, depreciation as a policy tool. At the same time, the People's Bank of China has cautiously allowed the yuan to strengthen below the psychologically important 7-to-1 level against the dollar, carefully managing its rise as the dollar weakens. Clinically speaking, the facts are straightforward. China is signaling intent, laying institutional groundwork, and slowly adjusting its currency position. But if you stop there, you miss the real story. For those who've been watching the slow but relentless transfer of power from west to east, this doesn't feel sudden at all. It feels like confirmation, like the final pieces of a puzzle snapping into place. For years, China has been quietly accumulating gold. Not paper claims, not ETFs, physical metal. Then more recently, silver, so strategically important that Beijing moved to restrict its export, effectively locking supply inside its own borders. These are not the actions of a nation content with the existing monetary order. These are the actions of a country preparing for a system where trust in fiat is no longer guaranteed and where settlement credibility matters more than slogans. From this perspective, Xi's comments aren't aspirational. They're transitional. They suggest China believes the conditions are finally emerging where a challenge to dollar dominance is no longer premature, but necessary. And once currency competition moves out into the open, it stops being academic. It becomes geopolitical. Look around. Pressure is rising everywhere. Trade routes are fragmenting. Alliances are hardening. Even recent U.S. moves, from renewed pressure on Venezuela to strategic interest in places like Greenland, begin to look different when viewed through this lens. Not as random acts of bravado, but as preemptive positioning in a world where monetary leverage is slipping. And right at the center of all of this, not on the sidelines, not as an afterthought, sits silver. Because silver is both a monetary metal and a strategic industrial input. It's the one metal that exposes the fragility of the paper system fastest when confidence breaks. And that's why many in the precious metals community are pointing to Friday's violent silver crash, not as a normal market event, but as a warning flare. In the aftermath of Friday's crash, the surface narrative was simple. Prices fell, leverage positions were flushed out, and the market moved on. But beneath that surface, the signals coming from the silver market are anything but normal. Silver remains in backwardation, a condition that historically points to stress in physical supply, where near-term delivery is more valuable than future promises. That alone suggests tightness. But what's more telling is what's happening in futures positioning. Despite the aggressive price smash, net volumes on COMEX tell a very different story. Outside of a handful of massive, concentrated dumps, overall volume has remained surprisingly balanced. That implies the price wasn't driven lower by widespread selling, but by force, through tactics like overnight spoofing and wash trading during U.S. hours. As prices were pushed down, derivatives unwound. Large silver ETFs experienced forced liquidations, not because physical demand disappeared, but because stops were triggered in a market where no volatility halts were implemented. This mechanical selling created the illusion of capitulation, but it didn't relieve the underlying pressure. In fact, physical demand moved the opposite way. One of the world's largest private silver vaults, the reserve in Singapore, reported that physical silver demand increased during the crash. According to their data, while there was some selling pressure initially, demand quickly overwhelmed sellbacks. By the weekend, net physical transactions across silver, gold, and platinum had already turned positive, even with higher surcharges and volume limits in place. They are now openly warning of a growing divergence between paper and physical markets and expect shortages to worsen. A similar event is unfolding in Sydney, where large queues of buyers are being reported in front of bullion dealers across the city. That's the contradiction at the heart of this moment. The paper price was crushed, but physical demand surged. The system looks calm on screens, but strained where metal actually changes hands. And historically, that divergence doesn't resolve quietly. So the question isn't whether something big is happening behind closed doors. The question is how long it can stay hidden, and what happens when it can't. And with currency competition now moving into the open, with China signaling ambition, and with silver behaving less like a commodity and more like a pressure gauge, this story is only just beginning. At this point, it's important to step back, because when events look chaotic, when price action appears irrational, the most valuable thing you can do is listen to people who have spent decades watching how these systems behave under stress. And that brings us to Peter Schiff. Peter Schiff is not a fringe commentator. He's been warning about currency debasement, bond market fragility, and the limits of central bank control for decades. And in the aftermath of Friday's silver crash, Schiff laid out an explanation that, while circumstantial by his own admission, is one of the few frameworks that actually makes sense of what we just witnessed.
Let me get into, what I think happened. And of course, I don't have any proof, right? I am just trying to make sense out of something that really doesn't make any sense unless you view it from the prism that I'm looking at it. So gold and silver prices had been moving up by record amounts, and the dollar had just fallen to a 4-year low, the dollar index, and this dollar had fallen to an all-time record low against the Swiss franc, and the bond market was starting to roll over. I think that Scott Bessent and some other people close to the president talked to the president and said, we got a problem here, right? Maybe Jerome Powell thinks what's happening in gold is irrelevant, but it's not. It is very relevant. And I think there was a real danger of the gold price and the silver price continuing to rise, but have that spill over in a more damaging way in the foreign exchange market and in the bond market. So I think the Trump administration realized that they needed to do something to stop this, right? They had to figure out a way to kind of derail this train, slow it down, do anything, buy some time. And so what I think they did is they coordinated with some short sellers, whether it's big banks, about, going after silver on the Thursday. Because if you look at what happened, right, the huge drop in the price of gold and silver in just a few minutes is the result of a huge sell order hitting the futures market, like randomly, like at the market. But then what the government did is Donald Trump ended up on Friday morning, sooner than was anticipated, because it was supposed to happen next week or this week. He announced his pick, Kevin Warsh, to be the new Fed chair. Now, when that pick was announced, there seemed to be a coordinated, PR campaign around that pick, that it was a surprise pick, even though, he had been a front runner, all along. He wasn't the front runner, but he was, a pretty good bet, like 30%, 40%. I mean, he, from the beginning. So it's not like he's a major outlier. He's somebody that was out there as, one of the guys, one of the top 3 candidates for Fed chair. So it's not like this, is a complete shock, right? But they try to spin it as if nominating Kevin Warsh means that Trump has now done something that was unexpected. And that's because they're now positioning Warsh as this major inflation hawk who doesn't like quantitative easing and who, doesn't like low interest rates, saying he's one of the few FOMC members when he was there before, around 2008 timeframe, who was arguing for higher rates and was a critic of quantitative easing. And so all of their media reports, and I think the administration was behind this narrative, and Wall Street ran with it, that, this is going to be, Warsh is going to be a hawk, and, he's not going to be a Trump puppet. He's not, Trump's not going to, be pulling the strings, and that he's going to be more hawkish than Powell, that he's probably less likely to cut interest rates than Powell, and maybe even he's going to start advocating for rate hikes, and maybe he's going to want to go back to quantitative tightening, right? This is how they're spinning it, right? That he's a real independent guy, hard money guy, Austrian economist, almost like they nominated me, right? Peter Schiff, or, they're not using my name, but, they say, well, maybe it's like Judy Shelton, or, like it's an unconventional pick, but this guy, is going to shake up the Fed in that he's a hard money guy who really wants to fight inflation, right? This is what they're saying, right? And so that helped fuel the sell-off in gold and silver. And I think whoever it was that started the selling on Thursday had the inside information that was probably going to happen. And it was all part of the plan to first hit gold and silver on Thursday, and then, that like a 1-2 punch, get the technicals like a reversal of one day, and then come out with this supposed surprise game changer to say, hey, everything you were worried about, right? People were worried about a loss of Fed independence. They were worried about, a Fed that's going to be slashing rates and doing QE. And in one, swoop, they diffuse that bomb and say, oh, look, Trump did something completely unexpected. So all the people who were buying gold and silver because they expected easy money, right? Rate cuts, lots of money printing, inflation. You're all wrong, because look who Trump picked to be the Fed chairman. He picked Kevin Warsh, right? He's an ultra hawk. It's like, Paul Volcker, right? This is what is out there in the media. And I think it's all a bunch of BS. I don't think that Trump would have appointed Kevin Warsh if he thought that's what he was going to do. Trump has spent his entire presidency criticizing too late Powell. Why is Trump criticizing Powell? Because he thinks we should have bigger rate cuts than the ones that we've already had. He wants to get rid of Powell because he hasn't cut rates enough. And he told everybody that he wants to put somebody at the Fed who's going to cut rates. Now, the gold and silver market believed that, which is why gold and silver hit record highs. But now we're expected to believe that that's not the case, that Trump has had a change of heart, that he no longer wants a Fed chairman who is going to cut rates. He wants one who's going to raise rates. And, Powell is not raising rates, so let's get rid of him and put somebody in there who's going to hike interest rates. There is no way that that is the case.
Schiff's argument ties directly back to everything we've discussed so far. If China is signaling reserve currency ambition, if the yuan is being slowly repositioned, and if metals are front-running a broader monetary realignment, then allowing gold and silver to run unchecked becomes politically and strategically unacceptable. From this perspective, silver wasn't targeted because it was weak. It was targeted because it was strong. And the timing matters. The rapid Thursday sell-off, followed by the carefully framed Friday announcement of a supposedly hawkish Fed chair nominee, looks, in Schiff's interpretation, like a coordinated 1-2 punch designed to reset expectations, cool foreign exchange pressure, and buy time. Not to solve the problem, but to delay it. Now here's where this gets even more compelling. Because while Schiff focuses on macro motive and political timing, Michael Oliver approaches markets from an entirely different angle: pure structure, momentum, and intermarket relationships. And despite that brutal sell-off, Oliver's conclusion is unmistakable.
I have to admit it's bigger than I would have expected. Okay. But there's too many things wrong with this being a top. We look at silver from all kinds of silver, especially from all kinds of angles, its own technicals, its relationship to other assets like gold, uh, other things that are going on in asset class shifts that are important, that are like wins at the back of the monetary metals and so forth. And no matter what I look at, they tell me, nope, if you're not in silver, and a lot of people aren't in silver, you ought to consider buying, right about now. In the prior explosive moves that we've noted before, back in 79 to 80, after several years of upside, silver went berserk in a span of a couple quarters on the upside. I mean, it just quadrupled in price. But in the middle of that move, roughly speaking, not in price, but in terms of the clock, you had a correction, one that was worse than any correction that had occurred during the process. And it looked like, oh, well, that's the top. And for a span of about 2 to 3 months after that first sharp drop, you could draw a line sideways through the weekly action or the monthly action and see up and down, but stability. So congestion. After a sharp drop, though.
Yeah.
And then when it resolved itself and said, okay, up out of here again, the next leg up in price was far bigger than the first leg part of the move. Okay. Same thing happened in 2010. Over a span of about 7 months, we had a signal based upon this. Silver breaking out versus gold. Silver's underperformed gold for quite a few years, and it's very low in relation to its historical norms.
Right.
An ounce of silver is worth how much ounce of a gold? And back in like in that 1980 move when silver peaked at $50 in that old antique range, okay, the spread was 6.5%. Silver was 6.5% the price of gold. Okay, and that wasn't a spike; it was up there for a while. Okay, and then in the bull market in silver that peaked in 2011, after running up for years, it reached 3.1%. Okay. Well, we recently got above 2%.
Yeah. Yeah.
So even though we're in new price highs above the entire old antique range, which certainly didn't allow silver to price itself according to the decay in the money unit. Okay.
Right.
It breaks through. You would think maybe in this bull market in silver, and I do think this, that metric, what's the price of silver versus gold, would get up at least and challenge the highs that it saw in the last 50 years.
Like
when
3%.
It was just at 50. So it'd be 3% plus, or maybe even 6%. Okay.
Yeah.
We only got up above 2. Okay. So we're still cheap. Okay.
Yeah.
But it's in a positive trend, meaning silver broke out versus gold. When you plot that relationship, there's like a 10-year ceiling that it kept it capped. And you burst through that in November. So we've had 2 months on the other side of that breakout.
Right.
In other words, that breakout's fresh. It's not old. It hasn't run for a year or something like that. And yet the base is 10 years wide. Okay. It's not a minor base. And then when you look at, let's say, asset class flows of, let's say, gold versus the S&P. So people say, hey, I'd rather own gold than the S&P. Well, that breakout of an 11-year wide base where gold plotted in relation to the S&P, how much is an ounce of gold as a percent of the S&P? And you plot that thing. There was an 11-year wide base with a lovely trend line running across all the highs. You broke out last year in November. So you've had 2 monthly surges. In fact, even this month, gold's up, S&P's down. So the spread's still working despite gold's sell-off today. That's a fresh breakout. A couple months ago out of an 11-year base. So those metrics, when you look at those spread relationships, meaning money flowing into monetary metals out of the stock market, just began. And in history, I've looked back, I know this, okay? There's no time when all assets go down. Yeah. That is a false notion. They always go somewhere else. People put their money somewhere else. And it used to be one of those places was bonds, T-bonds.
Sure.
Okay. 60% stocks, 40% bonds, the old orthodoxy. Well, even the head of, I think, Morgan Stanley's chief investment officer several months ago said, you'd rewrite those rules. It should be 60, 20, 20, 20% gold.
Yeah.
Even though it was less percent than he should have given it, but still, at least it was an admission that the old reality isn't working anymore.
Right.
Meaning T-bonds are not the alternative.
Yeah.
In fact, they're a time bomb in terms of risk. So, I mean, what does that leave you with? The stock market's gone nowhere for 6 months.
Yeah.
We think it's in a topping process.
Mm-hmm.
Real pain won't be evident till, let's say, later this year, I think. T-bonds are anemic as hell, even with the Fed buying them since November. They said, we're buying bonds. Well, you look at a price chart of T-bond futures, it can go down. Yeah, it looks like they've been supported because they haven't collapsed.
Yeah.
But it looks like who's ever buying them really can't get them to go up. Okay?
Right.
So you're left with what? I mean, you're going to put your money somewhere. Where? Okay. And you're left with gold.
Mm-hmm.
Now, and then the other argument that something's wrong here about thinking about gold and silver being at the top. Because when you shift over to the commodity complex, cheap real assets in the ground, growing above the ground, whatever, okay, they're as cheap as they've ever been in relation to the S&P. But their long-term metrics say the Bloomberg is just now breaking out of a 15-year parallel channel of price, and its annual momentum broke out in October, coming up through 106.50. Right now it's trading about 119, 120. So commodity assets are just turning up. How does that make sense? If gold's topping, why would commodities be turning up? Okay. Too many things argue here that, hey, yeah, it's a sharp break.
Yeah.
But so was the initial rise. So, give it its chance.
What Michael Oliver is telling us is crucial because it strips away emotion and replaces it with historical context. Sharp corrections do not disprove bull markets. In fact, they often define them. Oliver reminds us that in prior explosive silver moves, particularly in 1979 to 1980 and again in 2010 to 2011, the most violent pullbacks occurred not at the end, but mid-cycle. These corrections looked convincing. They shook confidence. They convinced many that the move was over. And then, after a period of consolidation, silver didn't just resume higher. It accelerated dramatically. More importantly, Oliver's inter-market signals align perfectly with the broader narrative we've been building. Silver has only just broken out against gold after a decade-long suppression, a breakout that is barely months old. Gold itself has broken out against equities after an 11-year base. Commodities as a whole are turning up from historically depressed valuations. Capital is rotating because the traditional refuges, stocks, bonds, even cash, are no longer functioning as reliable stores of value. That's not speculation, it's structural. And when you place that alongside China's currency ambitions, physical metal tightness, and increasingly desperate price interventions, the conclusion becomes hard to escape. This move is early, not late. This is what a revaluation process looks like in real time. COMEX and LBMA are being drained of physical metal, gold, yes, but especially silver, while paper prices are smashed lower to buy time. At this stage, shorts don't care about fundamentals. They care about keeping paper prices suppressed long enough to unwind exposure and minimize losses. But suppression doesn't end bull markets. It accelerates them. And when this process finally resolves, it won't be subtle. Silver won't be repriced in dollars. The dollar will be repriced in silver. A gold to silver ratio of 15 or lower isn't radical in that context. It's conservative. And yes, risk aversion is gripping markets as February begins. Gold down. Silver hit again. Traders hesitating. Lunar New Year approaching. All the familiar excuses are being rolled out. But step back and ask the harder question. If this sell-off was meant to restore confidence, why is physical demand exploding? Why are inventories vanishing? Why are lease rates screaming stress? Why are global prices diverging instead of converging? Because this isn't a correction in silver. It's a correction in belief. So when people tell you silver is too volatile, remember this. Volatility is what happens when paper promises collide with physical reality. The West is defending a system built on leverage. The East is locking down supply. The currency wars are no longer theoretical. They're out in the open. And silver is no longer just a metal. It's a stress fracture in the global monetary system. If you're still watching this, you already understand this isn't about chasing price. It's about recognizing what breaks first when a monetary system is under pressure. Silver is no longer trading as a commodity. It's trading as a fault line. And once those fault lines shift, they don't move gradually, they snap. So if you found value in this breakdown, subscribe, because this story is unfolding in real time and most of the media either doesn't see it or doesn't want to explain it. Share this with someone who still thinks price equals reality. And leave a comment below. Do you believe the paper market survives this year? Or does physical finally force the reset? Stay alert, stay skeptical, and most importantly, watch what they do, not what they say.